So to begin our quarterly commentary, let's talk about the economy both in the United States and around the world. What's fascinating about the first quarter of this year, we have seen a continued and consistent global synchronized recovery across the world. Strength is showing up across the globe. As we'll see in our first chart, the green shows where PMIs are advancing. Now, what a PMI basically is a measure of the economic strength and the forward look of economic strength in any individual measured country or economy. Anything above 50 means expansion. Anything below 50 means contraction. So as we'll see, very few red dots here across the globe. It's green across the board, and that, of course, is contributing to this advancing economy and the steady growth in the economy, this acceleration in the economy around the world. So one of the questions we consistently get here in the first quarter is, does this expansion have room to run? That question is a very fair question given, as we'll see on this chart, we are in the second longest economic expansion in recent history. So we have to go back to 1991 through 2001 for an expansion that actually lasted longer. So 9.5 years into an expansion, can it continue? Well, the answer is yes. We're going to talk about the individual contributions to economic growth, but also it's important to take a step back. Now, what factors actually contribute to this expansion? Well, if we look at the main factors, first we see U.S. consumption. 70% of the United States economy is U.S. consumption. This is it, folks. This is the driver. This is going to make or break the economy. And as we'll see, the consumer is strong. The consumer is still moving forward. And most importantly, the consumer has put itself in a position to continue to have strength with its balance sheet. Manufacturing is starting to pick up. We're starting to see the symbols across different economic measurements that show us that manufacturing activity is getting stronger and stronger. Again, that helps, that brings in capital expenditures, that drives further growth, which leads us to the next factor, CapEx spending. Confidence leads to spending. And so when we look at factors like CEO confidence, small business confidence, consumer confidence, all of those continue to register at significant highs. So that is the precursor to additional CapEx spending. Again, green light looks interesting. Lack of excess, we just don't have inventory overhang. Inventory overhang tends to happen in slowdowns because manufacturing continues, inventory builds, people are expecting sales that don't come. Not the case right now. Right now, the economy is growing and accelerating, low inventories. Government stimulus, so that's been all over the news. We have a new spending bill. We're going to increase spending. And while that may create concerns about deficits, for now, for our purposes today and in the short run, spending is a part of that GDP growth, and that's only going to increase over the next year as the new spending bill starts to kick in. And finally, the central bank. So this is probably one of the areas that right now is causing the most concern. The central bank has started the process of contracting money supply, raising interest rates, but for now, we're still in a very accommodative Federal Reserve policy. So our view of this is we're not in a situation where that will start to pull back the economy. So let's dig into these factors individually and talk about the statistics that drive us to these opinions. So let's start with the U.S. consumer. So what we'll see on this first chart as we look back, really back decades in time, we look at the consumer's power to grow. And this measurement is their net worth as a percentage of their disposable income and their total net worth. So obviously over time, from back in the 40s to today, net worth has grown for the consumer. That's logical. The economy has grown, the country has grown, net worth grows, that makes sense. But the measurement of net worth as a percentage of their disposable income is the important statistic here. If our net worth is high, that breeds confidence, that gives us buying power, and the consumer is off into the economy. So we'll see in the chart, I think the specific data points that look interesting is consumer buying power was very, very high relative to disposable income in '99. We had a bear market, that pulled back, recession. Grew again into '07, booming economy, everything looked great, and then we had a stock market crash, pulled back in a recession. As we look today, the consumer is in the strongest position of net worth relative to disposable income that we've ever seen. So, check the box, consumer looks strong in this regard. So let's take a look then, what is the impact of all of this economic force on the markets? Well, looking at 2018's first quarter, we'll see that markets didn't exactly equal the strength of the economy. This is an important point. The economy doesn't necessarily drive the markets. The markets will move relative to their valuation and expectation. So we're going to break these markets down and show you why for the first quarter, while the economy continued to do well, we can see here markets were actually pretty mixed, flat to modestly down. As we look into individual sectors, almost every sector other than technology and consumer discretionary down for the quarter. If we look at bonds, interest rates, the Fed starts raising rates, bond prices are going down because bond yields are going higher. And so across this landscape in the first quarter, we have this disconnect. The markets aren't doing well, bonds aren't doing well, stocks aren't doing well, but what we're hearing is the economy is doing well. We're going to talk about that disconnect here in detail as we start to dig into individual valuations.